All right, Mick. I think we might just get started for those that are nice and early. Mick, I'll throw it over to you. In terms of questions, guys, as we go along, just type them in, and I'll ask them of Mick at the end. Mick, thanks very much for making the time at late notice. It's much appreciated, and I'll hand it over to you.
Thanks, Simon. I'd like to give everyone an overview of Uniti, which is quite a large Uniti Group, a young company that's grown into quite a large company throughout calendar year 2019. In 2019, we were the best IPO, having listed in February of 2019, and prior to listing, the company was in a loss-making position. Since listing, the company has acquired a number of businesses in some identified market segments that the management team identified where the company should invest into the future. The result of those strategic investments in acquisitions and continued organic growth and efficiencies through the acquisitions, the company has grown throughout calendar year 2019 to be on the verge of entering the ASX 300, to achieving a market capitalisation in excess of $500 million in what is a little over 12 months effort. Today, the company has a very strong board and executive management team that has been attracted to the company through either acquisition or through the growth that it has achieved. In December of 2019, following the last of our acquisitions of 1300 Australia, we advised the market that our forecast earnings on an annualised basis was expected to be $32 million. That did include the benefits of some recent acquisitions, and that was on the 4th of December 2019. Shortly thereafter, we concluded the year, and not long after the end of the year, we sat down and had a look at where we thought the company was at, considering the growth it had achieved and the acquisitions we'd performed throughout CY19. And we reproduced an outlook that indicated that we expected earnings for the second half of FY20 to be in the range of $17.5 to $18.5 million, or $35 to $37 million on an annualised basis. And that increase or upgrade in earnings was a result of the successful acquisitions and the integration of those acquisitions and the organic growth that we had achieved. And in early February, we issued an upgrade to market, a 12.5% increase in what was our previous forecast of 32 million in December to a range of 35 to 37. When we released our H1 results at the end of February, we provided a further upgrade that we expected our H2 exit run rate to be in the range of 38 to $40 million, a further upgrade on our 35 to 37 million range. Once again, it was a result of improvement in organic growth over and above what we had achieved to date. Friday last week, we issued another release to market to update the market on any perceived impact that COVID-19 may be having on our operations. In the update last Friday, we advised the market that we did not expect any impact to our forecast earnings at this point in time. We reaffirmed our earnings guidance, our H2 exit run rate, that's June 2020 times 12 exit run rate of $38 to $40 million. We also advised the market that the months of January and February that were implicit in the original forecast or outlook, our actual results had exceeded January and February, and that all of our revenue metrics for the month of March were above the forecast that we previously provided to the market. We also confirmed to the market that COVID-19 at this point in time had not affected our supply chain, and we were continuing to purchase inventory and capital and infrastructure for capital expenditure as and when required. In the last month, we have boosted our inventory stocks, and we have increased the amount of capital on hand to continue the investment in our network builds. Notwithstanding, we also advised the market last Friday that we had increased our cash on hand at the end of December of $33 million to in excess of $36 million at this time. The company is trading highly cash flow positive. More than 50% of our EBITDA is in free cash flow after CapEx. Our debt on balance sheet is $2 million only, and that is debt owed to the South Australian government on favourable terms. And today we have $36 million cash at bank. So not only are our operations continuing to grow month on month, our organic growth is very strong. Our balance sheet is very strong with no debt. We have in excess of $36 million cash in the bank and minimal debt. What has underwritten the growth of Uniti since its listing in February, where we've taken a loss-making company into a company on the verge of earning $40 million EBITDA, is we've invested in market segments where we identified, we as a management team identified, we invested in segments where we could identify businesses that had three core attributes. One is there wasn't intense competition. We were not going up against the 4 or 5 major telecommunications businesses that operate in Australia today in highly competitive markets where it is very difficult to grow a company quickly. We came together as a board and management team to turn around this company and to grow it very quickly. And we didn't hide from the fact that we were going to remake the business model and the business strategy. And we sought to invest in 3 sectors where we could see minimal competition, very high margins, and great cash flow generation. And as a result, we've transformed the company to achieving EBITDA margins north of 50% at this point in time. Free cash flow after CapEx greater than 50% of that EBITDA. And the company has performed so well in the calendar year since listing that the tax losses that came with the business before listing, we were compelled by our auditors to recognise a tax benefit because the certainty of recovery of those tax losses was now assured with the turnaround that we've achieved in the company. Importantly, with minimal debt and no interest and no tax payable for the next 12 to potentially 18 months, our EBITDA after CapEx, after growth CapEx, is cash flow. What has underwritten the growth of Uniti is we've identified 3 market segments where we saw strong financial metrics, where we could invest and provide great returns for shareholders. And those 3 market segments are in wholesale and infrastructure. These are businesses that build fibre to the premise networks. They build networks as an alternative to NBN. We don't overbuild NBN. We build into greenfields, multi-dwelling units and broadacre estates in competition to NBN as an alternative to NBN. Yet we build fibre to the premise. We're not building multi-technology. We're not building fibre to the node or wireless and satellite that have throughput and speed issues that may not meet the data demands of consumers into the future. And we are building in greenfields, and in most cases, we are the only fibre to the premise provider in those greenfields markets. Our competitors are cellular wireless data networks. During CY19, we acquired 5 businesses in that fibre to the premise marketplace, otherwise known as private fibre network operators. During CY19, we also invested in acquired companies Phone Dynamics, Easy Inbound, Call Dynamics, and 1300 Australia. In that specialty services division, we provide premium voice services. They are voice services over 1300, 13 and 1800 phone numbers. And through 1300 Australia, we acquired a phone names business. 1300 Australia acquires phone names, owns those phone names. So they are numbers that represent a word that are some of the major brands in Australia today that use these premium voice services for marketing and customer care. Those are the sort of voice service that we're seeing an explosion in usage at this point in time with the COVID-19 issues in our community, those numbers are becoming even more important in managing customers and managing services for consumers. And during CY19, we also invested in consumer enablement, in a consumer enablement business. These are businesses that enable consumers to utilise the fibre to the premise infrastructure networks that we've acquired through those acquisitions and that we operate today. All three of these businesses operate in sectors where there is not intense mainstream competition, but there are very high margins. The benefit of investing in those businesses over the calendar year 2019, as you can see there, has meant we've built three very strong business units, and our goal and strategy has been to integrate within each business segment. We do not integrate across the segment. We've acquired like businesses in three pillars and have integrated within the pillar. What that has meant is we've achieved cost efficiencies rapidly, far quicker than we originally envisaged. And just as importantly, we've been able to achieve organic growth in each of those business units. And once again, that organic growth has been achieved at a much faster rate than we anticipated. And as a result, that's transferred into cost savings, and it's transferred into very strong organic growth. And that is what is underwriting the earnings growth that we're now forecasting through the remainder of FY20. And this business performance, once again, has been underwritten by strategic acquisitions in business segments that we've identified that have those key economic metrics of minimal competition, high margins, and very high cash generation. Very quick integration within the vertical and not across the vertical. Achieving growth very, very quickly. And that's all underwritten by a very experienced board and executive team that provide a shared services support to our three operating businesses. Our financial results for H1, $7.2 million EBITDA for the half, but we did not have the benefit of all of the acquisitions for the full half year. Our exit run rate, as I mentioned, for December was $33 million, the month of December times 12. That were the actual audited earnings achieved at the end of December. As I stated previously, we forecast 32 at the beginning of December. We exceeded our expectations by the end, achieving 33. By the beginning of February, we were ahead yet again, and we were forecasting 35 to 37 on an annualised basis EBITDA for the second half. And for June, exit run rate, we're beyond our expectations again and upgraded the market to a $38 to $40 million expected exit run rate. To reiterate, where the business is performing at this point in time, despite the impacts of the virus and the economic conditions, worsening economic conditions, we are outperforming our outlook. Our cash generation is in line with the metrics that we expected, and our cash that you can see there that was at 33 million at December is now in excess of $36 million. Against that, we've boosted our inventory and capital on hand for infrastructure investment. We have had a small negative working capital so far over the quarter, but notwithstanding, we have grown our cash at bank. We have minimal debt, and despite boosting our inventories on the basis of any perceived risk in supply chain, we have not seen any supply chain interruption at this point in time. Pleasingly, we've seen no impact upon our employees at this time. They're as diligent as ever. We've had no impact from the virus across any of our workforce. The majority of our workforce has been enabled to work from home, where people can safely work from our existing offices, in particular in Adelaide. That has also been enabled under a very safe working environment. So today we are continuing to grow against this background of worsening economic conditions. Most importantly, we are a defensive company in these times. Our products are commodities highly demanded. They are essential services. It is broadband, it is connectivity, and it is communications platforms, all of which demand for has increased and continues to increase during these tough times. And as a result, we're continuing to generate positive cash flow. Our growth CapEx is small relative to our earnings. We expect it to be no more than $5 million in the half, against a $40 million EBITDA with no tax and minimal interest on a $2 million only loan. You can see why we are generating the cash levels that we are. I might quickly talk to the three business units. Our first, the wholesale and infrastructure business, as I mentioned, we build fibre to the premise networks in greenfields predominantly, multi-dwelling units and broadacre. It is a market where there are a number of smaller operators. Our main competitor is NBN. We are the alternate to NBN. We compete with NBN. NBN does not overbuild our network. The returns out of this business are very strong. Our recurring revenue is 90% of our total revenue. We are a leader in this space, in the MDU space, the multi-dwelling unit space. It has a unique characteristic in that the CapEx event and the revenue events are very close together. From the time that you start spending your CapEx to the time you start billing customers is much shorter than in broadacre markets or subdivisions in which we build. That doesn't mean we don't like broadacre, and we are looking to expand into broadacre. The EBITDA margins in this business are very healthy. At the moment, 55%, we see them growing to 65%. Our annuity growth is very strong. These assets that we build are 20-year plus life assets over fibre that delivers the highest capacity data and broadband services in terms of technology choice. There are adjacent markets in which we can grow into, retirement living in particular. There are additional services, converged services that we can bundle with the fibre to the premise networks that we're building today, that we are looking to invest further in. That's smart building and smart city services, security, CCTV, Internet of Things, a whole range of services that can be converged on the fibre networks that we build. And most importantly, this business, despite investing heavily in infrastructure, is generating free cash flow greater than 50% after its growth CapEx. Today, at December, we had 35,000 active ports on our network. At this point in time, it's approaching 38,000. In what I call in the factory or ports about to be built or contracted to be built, there are another 37,000 ports that we should see come to market in the next 2 years. That is an important characteristic of this business. The organic growth is locked in very early. You can reliably predict your revenue and your profit growth well in advance of when it is achieved. ARPUs increase naturally. We don't need to implement price rises. ARPUs increase by people moving from lower speed plans to higher speed plans without a price increase. So you've got natural revenue growth occurring as people's consumption of data and increased demand of broadband occurs in society. In the future, we've now aggregated or acquired 5 very good businesses in this fibre to the premise market. Good businesses that have been fully integrated into one operating system, one billing platform, one provisioning platform, a converged workforce that is now ready to grow aggressively in market. We've got a large market to grow into, and NBN dominates that space, and there's a great opportunity for us to continue to grow by taking share in this space. There's also opportunities for us to grow by expanding our capability and expanding into adjacent markets. And they are initiatives that are all in the process of being implemented throughout 2020. On the regulatory landscape, there is legislation before Parliament that is important in understanding our business. None of these new regulations create any significant impact to our business, we believe, at this point in time. At this point in time, there is some doubt whether this legislation will be implemented. The core piece of regulation under debate is a telco law reform package. That sees the implementation of three key elements: functional separation, meaning that we can be a vertically integrated carrier, that is, being a retailer and a wholesaler across our fibre to the premise networks as an infrastructure owner, albeit so long as we are functionally separated and we meet certain ACCC guidelines. That is an advantage to our business in the future. We see not a negative impact. The regional broadband scheme is otherwise known as the Bush tax or the internet tax, was mooted for implementation 1st of July. I think there is some doubts whether this will proceed at this point in time, considering the impact of the environment, of the virus on the economy and community, and whether the government would seek to implement an internet tax at a time when the internet is more valuable than it has ever been in Australia's history. And the third element is the SIP framework, which effectively replaces Telstra with NBN as the statutory infrastructure provider to the industry. The regional broadband scheme, if it's implemented, the tax, it only applies once you exceed 55,000 active services. At this point in time, we're well short of that number, so it will have no impact on our business in the next 12 months. I hope it does. I hope we get to that many ports, because the business will be in great shape. Our consumer and business enablement business enables retail service providers to provide services over our owned infrastructure. The importance of that is it drives utilisation of our fibre networks. Our earnings, our fibre earnings and the earnings of Uniti are highly sensitive to the utilisation of our fibre network. To date, we're achieving an approximate 54% utilisation. That is 54% of the services that we've connected have billed services on them. As that ratio or utilisation increases, our profits increase, and 100% of that increased billing falls to the bottom line as earnings, because the network is a sunk cost. Driving utilisation over our network by enabling third parties to retail on our network and supporting our wholesale customers enables us to grow earnings quite well. Our earnings are more sensitive to utilisation than they are to any other factor. So enabling people to resell our networks is fundamental to continuing the growth that we have seen to date. With limited time on our hands, I wanted to jump into our specialty services business quickly, just to explain to you this business. I found in the market in recent times it's not as well understood as it should be or could be, and certainly not under the financial metrics are not as well understood. Effectively, we provide premium voice services. We are not a voice carrier. We do not provide local, long distance, international, fixed to mobile voice services, traditional voice services that have been in decline for some years now. We are providing premium voice services. These voice services provide value-added analytics and call tracking and information flow on the nature of callers and what they're using these voice services for. It's used primarily by marketers and customer management, customer care functions. It's used by government extensively at the moment in managing welfare and health benefits in the community. They are value-added services, they are premium services, and as such, they attract a very high margins in excess of 50%. During CY19, we also acquired a company, 1300 Australia. It leases phone words. It buys a phone word. It then owns that phone word for the period of time at which it elects to own that word, and then leases that word to third parties. So businesses like Bunnings and words like 1300 dentist, 1300 plumber, 13 rental, and those words are used to identify and distinguish businesses. And those words are then used to provide the premium voice services that phone dynamics, call dynamics, and easy inbound provide the tolling or the usage on. 1300 Australia did very little tolling or provided very little voice services over the words. The customers who acquired phone words acquired carriage services or tolling services from other carriers. The benefit of the acquisition of 1300 Australia is we move to being an owner of the phone number, the phone word, and also a provider of the carriage and tolling services converged. As a result, our Specialty Services division has financial metrics, earning metrics that resemble an infrastructure business. It is virtual infrastructure. So in the case of our phone words business, our gross margin is 93%. In the case of phone and call for the carriage services, it's a blended around a high 60%. The blended gross margin across the Specialty Services division is in excess of 75%. The EBITDA margin is 61%. They are margins akin to an infrastructure-based business. They are similar to our fibre infrastructure business. But most importantly, EBITDA in this business equals cash. And that cash is then available for the group to enable us to continue to invest. We're going to invest that cash in two main areas. One is continuing to invest in infrastructure, winning the right to build in greenfields, expanding into adjacent greenfields markets, but also expanding into brownfields. And the high cash generation of the business enables us to continue to invest in infrastructure and continue to earn those margins and to continue to grow aggressively. That also enables us to continue business within our verticals, within the three business units or pillars that we operate today. We have a very strong balance sheet. We have very strong cash generation. We're able to continue to invest in businesses within those verticals or pillars and provide the earnings accretion that we've already achieved in the last 12 months for shareholders. And that earnings accretion means, and the integration within the pillar means the gross profit of businesses we often acquire is EBITDA in our hands.
Nick, I might just because we're running out of time, I think I have a few minutes left. Are you cool if I just ask a few questions that we've had submitted through?
Yeah, please do.
So first question, what does LBNCo target the investor apartment market? What's the outlook for this segment in the apartment market? What has the experience been of LBNCo in difficult economic conditions?
Yeah, so we've integrated LBNCo and a number of other of the acquisitions we've made in the private fibre space into one business unit now. Very well managed by Steve Picton as CEO, and it's a fully integrated business. So LBNCo in its own right now is not as easily distinguished because it is fully integrated. So I'll talk about that pillar or business unit. In December, we were generating net new active premises of about 320. In March, that's grown to a point where we're pushing towards 1,000 new active premises. So we've seen significant organic growth in that business over the last few months.
Next question, on the wholesale non-recurring revenue, do you make a margin on this revenue? Is this all install revenue?
90% of our revenue is recurring. Only 10% of our revenue in our fibre division is one-off install revenue.
And next question, Telstra is a key reseller partner of 1300 Australia. Is Telstra reselling other phone name providers or exclusive to 1300?
Telstra is about 40% of the 1300 Australia business today, and I don't believe they're a reseller of any other phone names businesses today.
Are the acquisition multiples for the deals you are looking at starting to come down to you?
Not in the last 3 months. We've got a number of opportunities that we're looking at that are small in size. We're not looking to access debt or equity markets at this point in time, as we mentioned to the market last Friday. We are looking at businesses that we can integrate quickly, as we've done historically, and generate the earnings accretion to shareholders as quickly as we've done in the past. The multiples have moved slightly downwards, but nothing significant at this point in time.
And next question, how do you ensure the numerous brands that you've acquired don't become a dysfunctional group of smaller companies?
Yeah, that's a great point that I probably should have raised. Our operating model of having 3 distinct pillars, business units, managed by 3 highly skilled CEOs, ensures that within the business unit, that unit functions efficiently, is fully integrated, and we can run a multi-brand strategy within a business unit. We don't integrate across a vertical or business unit or pillar. We don't do any cross-selling across that. So multiple brands can exist across our group. Most importantly, sitting over the top of our group is a highly skilled executive team that's been brought together to deliver the outcomes that we've achieved today. And that executive team owns the group business. In that executive team are the 3 CEOs of the revenue generating businesses. But those CEOs play an everyday active role in the guidance of the group as a whole. So we have independence and autonomy and P&L ownership, and people very driven to deliver an outcome for their business unit. But at the same time, we're developing a culture across the group, and that's a culture of continued success.
And just a final question, Mick, before we have to wrap up. Interested in the company's plans for protecting their employees during this time. Are they working from home or still at work premises? In addition, are the company's white lines secure for the foreseeable future? Are installations to premises continuing, or have they been suspended?
Yep. Construction we have had no cessation of construction at any of the sites where we're building our fibre infrastructure at this point in time. We have had no supply chain interruption. We have been placing orders for inventory and equipment this week. As I mentioned, we have built up our stocks, and notwithstanding, we've still grown our cash as we've guided the market. So no supply chain interruption. The majority of our workforce is working from home at the moment. We've made other than 2 groups of people, our customer care service, our customer service people who support our consumer business are continuing to work from our offices in Adelaide, but we've redesigned the office to ensure their safety, and they are isolated. And those people in that operation in Adelaide that can work from home. The remainder of the employees are working from home. Our field force has been separated, so our teams have been reduced to teams of 2 people, which means they can remain isolated, and they are following all of the safety procedures that have been implemented at construction sites. Fortunately, at this stage, we've had no employee impacted by the virus, but I can confirm the diligence with which we've seen all of our employees deliver the results for shareholders we've seen in the last 12 months is continuing through these tough times.
Great, thanks very much, Mick. It's been a really comprehensive presentation, and thanks everyone for joining. It's been much appreciated on a Friday afternoon on lockdown. But Mick, if there's any other questions that we haven't answered, I'll CC you on the email and we'll get back to everyone else who missed their questions. But thanks everyone for joining.
Thank you.